One of the founding principles of Real Vision when we set this up was to bring balance and truth to finance. And recently, one of the most frequent requests we've had is to bring some balance, as there's been a lot of bearish commentary on the site. Now, again, we haven't been out seeking bearish commentary, just more and more people that we've spoken to have been bearish. So we're going to bring back Mark Dow, the founder of Dow Global Advisors. Mark gave a great interview back in 2015, at which point he was extremely bullish. And we're also going to bring Tom Lee, the co-founder of Fundstrat Global Advisors. And we're going to hear from Mark Ritchie II, who's the managing partner at RTM Capital Advisors. Now, all three of these guys are bullish, constructively so. So we wanted to get a sense from them as to where they think the market stands now and just update this bullish side of the argument. And we'll kick things off with Mark Ritchie II.
So I'm bullish on the U.S. equity markets specifically and the global equity markets. But before I get into that, I want to lay out that just about everything I say has to be framed with a tactical perspective and a bent towards risk reward. So my background is in trading and everything comes through the lens of risk reward. So right now, I just don't see any real reward to being in 100% cash or being short the equity markets. So if we start from there, then I want to kind of roll back and look at what has the bear argument been for at least 24 months, if not 72, to 128 months, or keep going, has really, in my mind, if you were to put it on the screen, it would be premise one: stocks are overvalued based on some classical metrics, say PE. Premise two would be, when stocks are overvalued based on whatever metric you use, markets either don't go up or go down. Conclusion, therefore, you should be in cash or maybe consider being short. And I think it's a valid argument. The problem is premise two is false. There's no reason to believe that when PEs are at a certain level, or CAPEs, or a lot of these traditional metrics are at what people claim are nosebleed levels, that stocks either don't continue to go up or go down. So in my view, I would just say that whole bearish thesis is not convincing to me. Again, if you pair everything in terms of risk reward, I don't think we have as many of the downside risks as a lot of people say. Furthermore, if we back up, say 12 to 24 months, and I would ask anyone to envision, okay, if you had a market, any market that is in a long-term uptrend, and then you had a 12 to 18 month consolidation where it corrected 20 to 25% and then broke out in the face of extremely negative pessimism, headlines, and negative sentiment, which way should you go? Should you fade the breakout or go with it? And a trader will say you absolutely buy that breakout and go against the crowd. Well, we're sitting here on about the 1 year anniversary of exactly that. I think we had a bear market in 2015. It has been the worst, advertised or publicized bear market, certainly in my career, maybe ever. And the reasons I say that is everybody likes to use this 20% bogey on the S&P or the Dow, which I think is a really silly definition. When we had a more than 25% correction in the average stocks, say, I'm speaking of the US broadly, the Russell 2000, the value line geometric. And if you look at, say, classical definitions of a bear market by Ned Davis, they'll use 13% off in the Dow over a certain number of days. We had a bear market. The problem for the bears was it wasn't enough. It wasn't big enough. It didn't hurt people badly enough. And I also think we actually had a recession. It just didn't hit the general economy. We had an earnings recession in stocks. Nobody argues that, but again, it just wasn't enough. So then what we had was the market consolidated, broke out in the face of terrible news. What everybody said was terrible news late last summer, and then retested after the election, which is a classic. As a trader, when a market breaks out, puts in a shakeout to the breakout, and then rallies, it's the sign of the beginning of a move generally, not the end. And if you look at the narrative, even some of the narrative that has been expressed somewhat eloquently at times on Real Vision, it turned into blow off top a month or two after, say the election. Then it turned into Trump bump and short covering and all these other things. And I'm saying if you study the market internals and some of the things we saw, I just don't see any reason to be, edge of the cliff, to use a quote, nervous. Many of the arguments people are making, it's going to end badly, etc., are all true. They're very early. And as a trader, I get very nervous when I hear people saying, I wasn't wrong, I was just early. I would say, as somebody who evaluates risk reward all the time, the trader's graveyard is full of epitaphs that read, I wasn't wrong, I was just early. And my question to a lot of the bears, of course, would be, what would change their mind? As I look around, and even some of the participants in Real Vision, which I have extremely high amounts of respect for, when I look around, I just don't see reasons to sound alarm bells yet. And when I do, of course, I'll make tactical shifts. And so I would ask people to honestly ask themselves, where have they been in the last 12 months? Underinvested, fearful, skeptical, negative, or wildly bullish, with 80 to 100% of their money in equities. And I'll bet if you did a survey just of Real Vision viewers, 80 to 90% would be in that 1 foot out the door camp. And that's what continues to push the market, not necessarily higher, but the market does what will fool the majority. The pain trade is often the path of least resistance. And I think the pain trade continues to be higher. And then if you look at, just look at the globe. This isn't a U.S. phenomenon this year, and there are many, many equity markets around the globe. If you look at 2 to 5, even 10-year charts, look very constructive to me. Just look at the chart on the other side of the room and say, does this look like the beginning of a move? Several of the European indices are trying to climb multi-year highs. The Nikkei's broken out of, I think, a 15-year base. And probably the best example of how psychology plays into all this is South Korea. In the midst of what seems to be one of the most panicked, or good reasons to be panicked, because of all the headlines around North Korea, and a few guests, even on Real Vision, have said, nobody stands to lose more than South Korea if there's a real conflict here. Their market is breaking out strongly to multi-year highs. That is bullish. Everybody's skeptical, negative, and nervous, and the market's telling a different story.
The framework I've been working with is pretty simple. When we did the interview last time in 2015, I wasn't bearish, and I was constructive, modestly constructive, and that's still the basic stance today. Framework is really that we had a global financial bubble, and economies had to work their way out, and are having to work their way out from underneath that leverage from a cyclical point of view. The advanced economies from a secular point of view have headwinds related to demography, globalization, technological substitution. And the combination of these factors is leading to a very shallow and a very protracted growth cycle. So it's going to be a slower rate of growth for a much longer period of time than anything we've come to know in our lifetimes. And that's playing out. I think the U.S. was first to come out cyclically from recession, and other countries are kind of following us with various lags. And when I become more cautious, when I become worried about a bear market, it will be when I think the U.S. economy has gotten out over its skis. And when I say economy, I mean the real economy, not just the financial economy. When firms have hired too aggressively and have invested too aggressively, that's when we become vulnerable to some kind of shock that leads economic operators to reassess their optimism and cut back on investment, cut back on hiring, and that pushes us into the vicious cycle that becomes a recession. We're not at that point yet. Too many people are looking in the rearview mirror at the crisis. Too many people are cautious. We're going in that direction, but we're going slowly. So my view is that we'll continue maybe for a number of years to this path where we muddle along. On the side of QE, it was helpful at the beginning to kind of kickstart markets and get animal spirits to begin the normalization process, but it's not really supporting equity prices here. I find it kind of funny sometimes that a lot of the people who are worried most about QE artificially holding up stock prices point to the bond market as a sign that the flattening yield curve as a sign that a recession is impending. And of course, QE has a direct impact on the bond market, and the effects on the equity market, though more significant back at the beginning, are indirect and now questionable at best, at least in my view.
As most of our clients know, we've been pretty bullish and continuously bullish on markets from 2009 through 2016. But as we entered 2017 this year, we decided to step back and be a little more cautious on markets for a couple reasons. One, we were kind of concerned that the market would have diminished risk appetite as the Fed began to tighten. We also saw some evidence that tightening labor markets would lead to inflation. While inflation is positive for corporate profit growth, it generally acts in the short term as a headwind for earnings. And thirdly, we just thought with presidential dynamics taking place, it's pretty typical to expect markets to have some sort of correction in the first 6 months of a new presidential term. But as 2017 is borne out, these concerns, all three of them actually have really been misplaced. Risk appetite has really increased with investors. And I think part of that is that the macro backdrop from central banks, despite what the Fed was doing this year, was really being offset by monetary easing by both by monetary easing by both the Bank of Japan and the ECB. So central banks weren't tightening this year, central banks were easing. Secondly, inflation has remained really tame, and I think it's been a bit of a puzzle, but I think it's something we need to capitulate on, that as long as there's no evidence of inflation, it's not something that we need to be concerned about in our work. And in terms of presidential dynamics, I think what we found was companies have really embraced this deregulation that's taking place, and that improvement in business confidence is something that I think is a lot more important than the presidential dynamics. So 2017 has been a great year. In the fall of this year, we decided to essentially reverse our stance. One of the reasons for that is that the high yield market in the US actually confirmed the S&P rally. High yield spreads had been rallying through March of this year, but then from March through September essentially waffled or consolidated, but in September they actually began to rally again. So we took that as a cue to say that credit markets are also affirming the equity rally, which is why we went from being cautious to essentially neutral on markets.
Well, I think the people who have been bearish for a while and continue to be bearish, there are two principal arguments. One of them has grown in time, and the other one has faded a little bit in time, but it's still rather strong. The first argument is valuations. That one has been growing because the U.S. has become more fully valued over the past 24 months. And they keep saying, well, this is out of whack historically. And they look at things like the CAPE ratio and other, there's some guys that continue to torture the data until it comes up with new bearish indicators. They're convinced, but the valuations is a more real issue over, at least in the U.S. It's become one over the past 24 months. The issue that persists, that I think is fundamentally flawed, is just been a misunderstanding of how monetary policy works. People confuse printing money with the money supply. People assume if you're printing money, it has to go badly at some point, rather than asking under what conditions does printing money end badly, and under what conditions is printing money benign or helpful. And I think going through that analysis, then you find some of the bigger flaws in the bear camp. There are a lot of guys, as I say, who think that stock markets are being held up by quantitative easing, but at the same time think that the bond market, where QE directly has an impact, is telling us that there's a recession. If anything, it's the other way around. That the bond market is impacted by QE directly, and the equity market is really running on its own. It's pretty clear, I think, since 2014, 2013. Now, a lot of guys would argue that no, it's because the Japanese and the Europeans have stepped up their QEs significantly, and I understand that argument. But if you look at the mechanism of monetary policy, how it works, that money doesn't go into the equity markets. To be honest, if we know that there have been share buybacks and it's been helpful, and the share count has been shrinking. There's also been relatively less IPO issuance, so that helps the supply and demand imbalance. But I think the bigger issue is really we had 30 years of financialization, where in the developed economies, advanced economies, markets were getting deeper and deeper and deeper, and there was a lot of creation of wealth, of assets. I mean, we all know about the income and wealth inequalities that have grown over the past 30 years. And that money is looking to invest. And the supply of investable assets is inferior to the supply of funds chasing those assets. It's true in the bond market, where people, insurance companies and others are looking for long duration assets. If you talk to the CIO of AIG or the CIO of BlackRock or PIMCO, these guys are looking for long-term assets. There's a shortage of long-term assets, and it's not entirely created by central bank purchases, although that is a significant factor that has exacerbated this. So I think to some degree the same thing is happening in stock markets. At the same time, we have an ETF phenomenon, and a lot of people point to that as something scary, but I don't really think that's the case. I really think what the effect of ETFs is you have guys now allocating to their Betterment account somewhat blindly, somewhat automatically, and they don't care what the valuation of Apple is. They just know $50 comes out of their bi-weekly paycheck, and it goes in there and it gets allocated automatically. So that tends to raise the equilibrium valuation of the equity market relative to the past. I just think there are a lot of guys that have been bearish for a long time, and they're looking for that one thing that's going to change, and then the whole house of cards will come tumbling down, and it's not that simple. There's a general mismatch between assets that need to be invested and investable assets that can receive those funds. That's the basic story for me. And at the same time, we have this global recovery, kind of a rolling recovery that's been happening in the U.S. for a while, and it's now happening in other countries. These are supportive factors. When I see the risk of the U.S. going into recession because people are too optimistic, people in the real economy are too optimistic and they're out over their skis, then I'm going to get concerned, but I just don't see that at this point.
The simple truth is the bulls have been right and the bears have been wrong. And if your strategy 6 or 7 years ago was simply buy it because it's going up, then you've ended up looking like some kind of genius savant. I'm not sure I buy Mark Dow's idea that the equity market rising isn't linked directly to central bank liquidity. And I think if that correlation breaks, we'll find out very quickly if that's true or not. But as I said, the simple truth is these guys have been absolutely right and the markets have just kept climbing higher for 6 or 7 years now. So Mark, Tom and Mark are all constructively bullish still of this equity market, which makes sense. They're a little bit more cautious because it's had a hell of a run. But what I wanted to try and do is get a sense from each of them as to how much further they believe this market could still run.
Well, I think it's important for investors to take the long view. And I think that's probably one of the lessons for us in 2017. And the long view is to look at both the state of the business cycle, and I think we're seeing a lot of signs that we're just mid-cycle in the expansion. Investment spending isn't overheated. There isn't signs of excess leverage. And I think that there are only limited signs of excess risk-taking, but there are some. And when you take a long-term view, valuation probably is secondary to what central banks are going to do, and also where we are in the business cycle. So, in general, I think that if we're long-term oriented, investors should be pretty constructive.
I just think the sentiment will wind up putting in a bottom, and we'll see the wall of worry go up so much even higher that on the other side. And again, I don't advise anyone just buying falling knives. You wait for the dust to clear, and I think that will be even another potential really good buying opportunity if we get there. That's assuming, of course, that the market doesn't really accelerate. The other side of the trade for me right now would be, in the short term, weeks to months, we may be a little stretched here. And if we really accelerated and say some of the FANG names, the big leaders, started to go parabolic and have some blow-off moves and things like that, I would start to revise my thesis and say that maybe we are ending in kind of a blow-off move. There's no signs of that right now. If you look at the Russell, it's sort of stair-stepped higher. The markets have just sort of continued to go up and digest and go up and digest. And I think many people missed this move, which tells me I think the next 5 to 10% is probably still going to be bought by institutions.
So the broadest possible view. So if you want to know where I think equities will be going over the foreseeable horizon, I think the broadest possible view is that we will grind higher, just because of this slow process of countries working out from underneath their debt burden and increasing earnings, and little by little growth is coming back onto people's radar. It's been there in the U.S. It's starting now in emerging markets. And even Europe has been growing reasonably well.
The key point for me from that segment is Tom talking about how valuations are secondary to what central banks may or may not do from this point on. And I think that directly contradicts something Mark said in the first segment. But again, either way, it's not to say either one is right or wrong. Whatever happens, if that prop of central bank liquidity is removed, the market is going to have to prove to all of us that it can stand on its own 2 feet after almost 10 years of being propped up by the central banks. Yes, as Mark Ritchie says, the markets have stair-stepped higher, and we haven't really seen any evidence of the kind of parabolic blow-off move we saw at the end of the 99 to 2000 dot-com bubble. But even by the law of averages, this is a very, very old bull market. What I wanted to do next, though, is ask our bulls what, if anything, might change their mind about this. And perhaps unsurprisingly, inflation featured front and center.
Well, I think one of the stories for 2018 is going to be that there are some changes taking place at the central banks. You know, that instead of quantitative easing, I think it's a year of synchronized quantitative tapering. I think it's also going to be important for investors to keep their eyes on inflation. Well, current headline inflation, and I think a lot of core measures are really tame and actually surprisingly tame. Some leading indicators like the New York Fed underlying inflation gauge has picked up. Some evidence that core prices are picking up. So I think we could be dealing with a less benign inflation picture next year. And then when it comes to valuation, I think one of the headwinds that could be emerging is that European high yield, after reaching some extremes, has begun to correct. And I think it's spilling over into U.S. high yield as well. And I think when you start to lose some of the tailwind from high yield, it means either stock selection becomes a lot more important, investors have to avoid leverage, or they have to start thinking about the general rise in interest rates.
What are the tail risks that I worry about? What are the tail risks that I see out there? For a long time, my answer has been, I'm not that worried about pretty much anything, because you can't commit suicide jumping out of the basement window. And we've had a global economy characterized by excess slack. Now that's being taken up. So yes, the U.S. could get to a point where it overheats, and inflation could pick up. And if the Fed has to raise rates aggressively, then that could upset the apple cart. As I said, I assign a relatively low probability to that scenario. We're just not normalizing back to those rates of yesteryear that a lot of guys grew to love in their investment careers. The rates just should not be going that high. There are risks out there, but I see all of them as relatively low delta risks. Yes, if we had a large enough shock of some sort, a nuclear explosion from Korea, North Korea onto Japan or something like that, could conceivably trigger a financial shock large enough to push the U.S. into recession. Because the way I kind of look at this is, it's about how vulnerable the U.S. economy is to recession, and the more vulnerable, the smaller the shock. But even if it's not very vulnerable, a large enough shock could push us into recession. All you have to do is change people's optimism, whatever the level of optimism that happens to be, and push it much more negative, so that economic actors cut back on investment, cut back on hiring. They lay people off, and that starts the feedback mechanism that leads into a recession.
So a few things that would potentially concern me. One would be if we had a really strong rise in rates. And I know there's been a lot of discussion about Fed policy and at what point is too much. And I just tend to think that even 10-year at 3.5%, if we don't go there extremely quickly, I think the markets will just adjust. And my argument would be even 10-year at 3.5%, even 4%, if we get there in an orderly way, I still don't see huge competition for equities historically. And this is why I think the trend is going to continue potentially where the value guys are just going to rip their hair out and say, this is crazy. Historical valuations, they're kind of missing that whole competition piece. I think the risks to being out of the market are higher than being in, especially if you're willing to bend.
So there you have it. And I'm the first to admit the bulls have been dead right, and I have been dead wrong. This bull market has continued, and while they're a little less carefree these days, they still seem to be fairly constructive and believe that this bull market has some distance still to run. I disagree with this notion that the removal of central bank liquidity is not going to affect equity markets in a meaningful way. And I do think that inflation is perhaps the one thing that could trip up all of this by pushing central banks into raising rates faster than perhaps expected. But as I said, time is going to tell where we go from here. Constructive bullishness, if a little more caution on the part of all our bulls, I think is the main takeaway for me here. Whatever happens, 2018 is shaping up to be a really important year. I strongly suspect that this low volatility environment, which has nurtured this bull market for so many years now, is perhaps going to disappear in 2018. And as our bulls have pointed out, inflation is a very real danger, because if inflation comes, central banks are going to have to change their game plan drastically, and that's going to have a major effect on markets. So I think if either of those eventualities plays out, then the bulls' case is going to be due for a serious rethink. But for the time being, even though, as I said, they're more cautious, they're still right, they've been right, and you have to give them the kudos they deserve.